Hi, and welcome to Northern Oak Capital Management's presentation on its dividend growth strategy. My name is David Becker, and with me is David Szatkowski. We'd like to start out with a little bit of background on each of us. I have an undergraduate degree in accounting and a graduate degree in finance from the University of Wisconsin. I am a CFA charter holder and have been in the business for 16 years, 10 with Northern Oak. Dave?
Again, my name is David Szatkowski, and I'm Vice President and Portfolio Manager for Northern Oak Capital. Like David, I also have a degree from the University of Wisconsin, a BBA in Finance, Investments, and Banking, and I also hold a CFA designation. I've been with Northern Oak 4 years, but my investment career spans a total of 40 years, of which I've spent an awful lot of that time researching and managing dividend portfolios. With those introductions, I'm going to move right into a description of our dividend growth strategy. The Northern Oak Dividend Growth Portfolio is an individually managed, customizable portfolio consisting of high-yielding, good quality common stocks that have above-average dividend returns, good long-term growth expectations, and have exhibited less volatility than the markets in general, using the S&P 500 as a benchmark. At the present time, the portfolio yields 4.3%. But in addition to starting with a good dividend return, the components of the portfolio are all companies which have exhibited long histories of increasing their dividends year in, year out, with the prospects pointing to a continuation of that trend. This particular product has appeal to any investor that is interested in a good, solid, growing cash flow, long-term growth expectations, and low volatility.
So why a dividend strategy? Of all the investment strategies you can consider, growth, value, momentum, why do you want to use a dividend income strategy? Well, first and foremost is performance. According to Ned Davis, a prominent firm in our business, they did a study that looked at dividend-paying stocks from 1973 to 2009. And they segregated those dividend stocks, and they compared and contrasted it against stocks that do not pay a dividend. And the results were significant. Stocks that paid a dividend not only had a superior return over those years, but they did it at a lot less risk. Another important factor to consider with dividend stocks is the percent of overall return it contributes to the portfolio. Here we have a slide by Morningstar that shows what percent of the S&P 500 is attributed to dividend income by decade. You can see that from a low of 14% during the 1990s to a high of over 70% during the 1970s, dividend income is very important to your portfolio growth. In fact, over the 80-year period, Standard & Poor's estimates that the total return of the S&P 500, 44% of that comes from the dividend income. Another important factor to consider with the dividend income strategy is the cash flow. Dave will talk about this in a little bit, but with yields near zero, whether it's money market or CDs, having dividend stocks that pay yields of 3, 4, 5% is very attractive to investors. And finally, relative safety. Typically, when markets go down, dividend stocks hold up a lot better. We'll show you a little bit more detail with that in our performance section.
David talked a little bit about why the dividend growth portfolio should be a part of your long-term investment strategy, and I'm going to take a few seconds to talk about why today is a good time to initiate that program. First of all, interest rates, as he alluded to, are near record lows. Your alternatives are basically less than 1% compared to the current return of 4.3% on the dividend portfolio. Secondly, corporate profits are running at record levels, currently running at $1.7 trillion. They've never been higher in the history of this country. In addition, the balance sheets of corporate America have never been stronger. As of June 30th, cash and equivalents on corporate balance sheets exceeded $2.5 trillion, the largest amount since the U.S. Department of Commerce started keeping records in 1946. The result of this has been significant dividend increases by many corporations, as well as share repurchase programs. The third reason is we've gone through 10 years of market uncertainty with two bear markets, and the one segment of the market, as David alluded to earlier with the Ned Davis study, was the fact that the dividend growth had relatively significantly lower volatility than the general markets and relatively higher returns. I'd like now to move on to the selection process that Northern Oak Capital uses in developing its dividend growth portfolio. We use the Zacks Research System database, which contains financial information on 6,500 companies approximately. We've developed 6 criteria which we quantify and screen against that database to find candidates within that 6,500 companies that meet the criteria that we're looking for long-term dividend growth. That screening process is an ongoing basis and generally produces a working universe of between 150 and 175 companies that meet the 6 criteria that we use regularly. I'm going to move right into those criteria at this point in time. The first criteria that we use is a stock has to yield 25% more than the S&P 500 stock index. At today's dividend rate, that implies a minimum dividend return of 2.75%. I just want you to recall that the dividend yield on the total portfolio today is 4.3%. The second criteria is a growing dividend stream. As I mentioned before, many of the companies in our portfolio have increased their dividend year in, year out for many years, with the prospects pointing to a continuation of that. In fact, in the trailing 12 months, this portfolio has had 28 companies increase their dividend out of the 32 that we presently own, and the average increase has been a little more than 10%. Now, that may not be realistic to expect in the long run, but we do believe that growth rates of between 6 and 8% are feasible and doable. And the slide that I'm going to allude to shows what would happen if one invested approximately $1 million at a mid-4% dividend return, what that cash flow might grow to in a 10-year period. And as you can see, under all 3 assumptions, 6, 7, or 8%, the cash flow nearly doubles in that 10 years. The next criteria that we're going to use is earnings growth expectations. In order for a company to raise their dividends consistently, they need to grow their earnings consistently. And the third criteria is we're looking for companies that have a projected 3 to 5 year earnings per share growth rate of a minimum of 3%. The portfolio currently is growing between 8 and 9%. The fourth criteria is payout ratio. And although we don't quantify this for each and every company, what we're looking for is a payout ratio which is reasonable and one that's not excessive where the dividend might be in jeopardy under any economic duress. The fifth criteria is valuation. This contributes to the lower volatility which we alluded to earlier. The specific criteria is we're looking for companies that have a lower price-earnings ratio than the S&P 500 stock index. Dave?
Studies have shown individual investors do not do as well as professional investors. We think a major reason for that is because individual investors typically do not have a solid foundation as to which to make their investment decisions. Usually buy and sell decisions individuals will get at a party, read in the paper, hear it on TV, but they really don't know what they're buying and selling other than a name. They really don't know the price. Valuation metrics are very important in our business to make those decisions. We're going to go through an example in here, but there are a lot of different models that you can use. There are PE models, or price-to-earnings models, there are cash flow models, there are economic margin models, a lot of different things you can do. We do a lot of them. I have an example here where we're going to do what's called a dividend discount model. We're looking at a company called Abbott Laboratories. And basically what the model does to derive the value of that stock, it takes the present value of the future dividend cash flows into perpetuity. Now, there's a lot of different assumptions you can make into a model, and they do change the price that you get depending on how sensitive it is. Now, this example we have here, on the left column, we're showing the dividend growth rate, and going across the top, we're showing an interest rate, or what's called a discount rate. And the cell highlighted in the middle is our assumptions, and that's based on what we think the value of the company is going to be. So we have about a $75 price target for Abbott Laboratories. Today it's in the middle 50s, yields just under 4%. So we think there are very good opportunities still with Abbott Laboratories, despite having a very sound 2011. Now, the nice thing about this model is that you can look at the sensitivities, and if your inputs are wrong, how does the value change based on your growth rate being too high or too low, or the interest rate assumption being too high or too low. And you can look at how that value changes, and it gives you a range of where you think that stock can trade. And it adds a lot of value to our success. We're going to talk about volatility, the last criteria that Dave started in our selection process. Basically, you want a portfolio that has less volatility than the overall market as measured by the S&P 500. And as I mentioned at the start of this presentation, you want a dividend strategy where the portfolio doesn't fall as much as the overall market. As our performance shows, we have a slide here of quarterly performance for the last 2 years. Our performance is in the gold bar, the S&P performance in the green bar. And basically what you see is in the up markets, our portfolio is capturing most, if not all, of the return of the S&P 500. And if you look at the 2 down quarters during this time period, you can see that we're only down about half of the S&P 500. And that's something that you want with a dividend income product. I'd like to make one final point. It's very important to have processes and procedures in place to develop the portfolio. But you also need to monitor the portfolio from an overall risk perspective. And one way we do that is to look at the sector weightings of the dividend portfolio that we run and compare that to the S&P 500. Now, that is very important to do. Back in the mid-2000s, a lot of these types of equity income strategies focused on financial names. Why? Because that's where a lot of the yield was. Citigroup, Bank of America, companies like that had very nice yields. And they actually had about 40-50% of their portfolios in this one sector. Well, guess what happens? The financial crisis hit in 2007, and these funds are hurt very badly. At Northern Oak Capital, the way we monitor that risk is we will look at the sector weightings of each of our sectors versus the S&P and look at those to make sure that we're not too heavy in one sector and too light in another, and we're spreading and diversifying that risk out over the portfolio.
Now I'd like to recap the performance that the Northern Oak dividend portfolio has achieved in the last 2 years. The next slide, again showing Northern Oak in gold and the S&P 500, shows the results for the past 2 years. In 2010, this portfolio had a 17% return compared with 15% for the S&P 500, consistent with what Dave was talking about with the capture ratio. In 2011, the portfolio had exceptional return, 13% compared to 2% for the S&P 500. And since inception, the return has been 32%, nearly double the 17% of the S&P 500 in that period of time. Next, I'd like to just summarize the principal advantages of the Northern Oak Dividend Growth Portfolio. First of all, it has provided very competitive returns to fixed income alternatives. The second main advantage to this dividend portfolio is the fact that the dividend stream should grow over time. Third, the expected total return has a good long-term growth component to it, something that may or may not be present in a fixed income strategy. The fourth advantage is the fact that this portfolio has demonstrated considerably less volatility than the markets in the last 2 years, and we expect that with a beta of 0.75 and a lower price-earnings ratio, that trend should continue. The fifth principal advantage to this strategy is the fact that the portfolio is extremely well diversified. We have representation in 9 of the 10 economic sectors of the S&P 500. We do not have any representation in the financials at this point in time. And finally, the last advantage is the portfolio has demonstrated good performance results, and studies over time have shown that dividend strategies should provide better than market returns.
This concludes our presentation on our dividend growth strategy. Thank you for taking time out of your busy day to listen to our story. If you have any other questions or like any other information, our contact information is on the presentation slides.
We would appreciate an opportunity to present this product to you in greater detail, and we'd also appreciate very much an opportunity to work with you. Thank you very much.